Hello everybody, and we're going to take a look here at chapter 14 pertaining to money, banks, and financial institutions. And when we talk about money, what we mean by money in an economic sense. So we're going to go through what is the function of money in an economy, what are the components of our money supply, what backs our money supply, how does the Federal Reserve or our central bank and our banking system work, what are some of the functions, responsibilities, and independence of the Fed, and end on what happened during the financial crisis. We're going to touch more upon the Fed in our in our final chapter of the course, chapter 16, pertaining to monetary policy. So in an economic sense, remember back to the beginning of the class, money is simply a medium of exchange. It's whatever is considered throughout the economy to be accepted for goods and services, and in this country it is the US dollar. And money has the following functions. It is a medium of exchange, so we can use it to buy and sell goods. It is a unit of account, so all the goods and services in an economy are valued in that form of money. As this is a US focused class, we're looking at goods valued in dollars. It's what's known as a store of value, so everybody holds at least some of their wealth in the form of money. Not everything you own are things. You always have some money to be able to buy goods and services and all of the other things you need to go through life. So that's why we consider it a store of value. And money is liquid. Liquid means it can be exchanged for something else, whereas something like your car or your computer, they may have a lot of value, but those aren't liquid. You would have to sell them, turn them into money, and then be able to use that money. You can't just generally throw someone the keys to your car for a bunch of goods and services. So in economics, consumer money is broken down into two things, M1 and M2. And M1 is liquid money, purely liquid money. It's currency and checking accounts. Currency are the dollar bills in your pocket, and checking accounts are what runs your debit card, or you might write a check from it. M1 is money which can be used to pay for things immediately. You can write a check or swipe your debit card, or you can use cash to buy something. Money that's M1 can be used immediately to buy something. So any currency, so coins and paper money, and any checking deposits, that is going to be M1. And banks, savings and loans, credit unions, things like that, those are who offer checking accounts. M1 is contrasted with what is known as M2, and M2 is what's considered near liquid money. Savings accounts are M2, not M1, because you can't use a savings account immediately to buy something. You have to make a withdrawal to liquid money. Small denominated time deposits, meaning any time deposit under $100,000, those are your CDs and things like that. Those are considered M2. And finally, money market mutual funds. Those are all accounts similar to savings accounts that give you probably better interest. But all of them are pretty liquid. You can pull money out of them. You might have to pay a penalty depending on how it's structured, but you can pull money out of them pretty easily. So we consider all of those M2. Why? Because these accounts are readily available for withdrawal, but you can't immediately use them to buy goods or services. If we look here in this pie chart, as of 2018, so 2018 is when this data was collected, about $3.7 trillion was M1, 43% currency, 57% checking accounts, and that makes up about 26% of M2, or about $14.5 trillion. The other percents are as follows: 4% small denominated time deposits, so things like CDs, about 6% money markets, and the money market mutual funds, and the overwhelming bulk, your savings type accounts at 64%. So M1 is part of M2, and M1 is what's known as the consumer money supply, or money available to be used immediately. So what actually backs our money supply? In the United States, our money is backed by the full faith and credit of the U.S. government, or the fact that the U.S. government has value in the sense that our economy is strong and all of what it has and everything else. That's what actually backs our money. Our money is no longer backed by precious metals and hasn't been in a very long time. A couple other things to keep in mind here. So money is guaranteed by the government's ability to back it and keep it stable. It's no longer guaranteed by gold or silver. You may have run into old money from the 30s or the 50s, gold certificates, silver certificates, things like that. Those are something from the past. What else are we going to look at here with money as debt? Credit cards are not money. In an economic sense, credit cards are a loan. When you swipe your credit card, you are short-term borrowing from your credit card company, and then you have to pay it back with real money. So even though you can use them to buy things, they're not considered money in an economic sense. They're a debt instrument. Debit cards are considered money. So why is money valuable in a country or in a society? For money to be money, it has to have all three things. Number one, it has to have acceptability, meaning you can use it in anywhere in that country, or whatever body issued it. Generally, it's countries. So the US dollar is acceptable anywhere in the United States. Legal tender means it is legally the money of the land, so that the government itself who issued it, it's legally the money of that country. Our dollar, once again, if you pull a banknote out of your pocket, will say legal tender on it. And finally, relative scarcity. The supply of money is controlled by whoever issues it. They don't just keep printing money into oblivion, and that also determines its value. As for money, one other point I'd like to make here, cryptocurrency is not money in an economic sense. It is considered an asset. The reason why is it is not acceptable throughout an entire economy. It is not legal tender, and some of them have relative scarcity. Bitcoin does, but other ones do not. Other ones are just continuously mined. So it all depends on the type. But regardless, they are treated as an asset, just like a stock or something like that, not money in an economic sense. So back to when we covered inflation. Prices affect the purchasing power of money. And remember, I said hyperinflation will destroy an economy. The reason hyperinflation destroys an economy is it makes money unacceptable. Zimbabwe in 2008 or so printed something that was called the $100 trillion bill, and it was worth a whopping 23 cents before it was scrapped. So hyperinflation renders money unacceptable and economies fall apart. They generally revert back to things like barter. And intelligent management of the money supply is very important. That's what's known as monetary policy. And monetary policy is control of the money supply. And that is under the purview of the Federal Reserve. We will touch upon that at the very end of this class, a bit in this chapter and then in chapter 16, and also appropriate fiscal policy, which is to come in the next chapter. So the Federal Reserve is our central bank in this country, and its historical background was in 1913, the Federal Reserve was created, and it is what's considered a public-private central bank. The Federal Reserve is run by the Board of Governors. They're appointed by the President, but the President only appoints one every 2 years. So there are 12 boards of governors. There are 7 members of the Board of Governors, 12 banks. They have 14-year terms, so that no one president can fully replace all of them. They have staggered very long terms, and they are not publicly elected, so they are not really subject to political pressure. The board gets continuity, experience, membership, and independence from politics. That's how the Board of Governors works. The Federal Reserve has 12 member banks, and they serve as our central bank. They're considered quasi-public banks because they are publicly controlled, but they're privately owned. They're owned by the banks that are their own members. So the New York Fed is owned by things like Chase and Citibank, so on and so forth. They're not profit motivated, but want to keep the economy operating and the well-being of the economy as a whole as their motivation. And they perform services to commercial banks that they perform to us. They lend money to banks. They're considered bankers' banks. And in times of economic stress, they can do things to prop up and make sure the economy is stable. Fed lends money every day to its member banks. So you have your Board of Governors, the 12 individual banks, and they're made up by the commercial banks and thrift institutions, and then those places loan to us. The Board of Governors and the Open Market Committee are who determines the policy of the Federal Reserve. The Open Market Committee is 12 people. It's the 7 Board of Governors the president of the New York Fed, and 4 of the remaining presidents of the Fed banks on 1-year rotating terms, and they meet regularly to direct the purchase and sale of government securities to control the money supply. We'll go into how this works in the next couple of chapters, and the purpose of this is to control the nation's money supply and interest rates. The Fed sets interest rates on the money they lend to other banks, and they also have power to control the money supply of the country. And here are the various Federal Reserve districts in the United States. Note, a lot of them are concentrated on the eastern part of the country because in 1913, that was where the overwhelming majority of our population lived. And the different colored areas with the numbers correspond to the territories that the Fed banks we're looking at here represent. The Fed Open Market Committee, they aid the Board of Governors in setting monetary policy. And monetary policy, once again, is policy which controls the money supply. And they conduct what are known as open market operations, or operations where they can increase or decrease the money supply. And that's something we are going to go into some more in chapter 16. Finally, commercial banks and thrifts. As of about 2018, when this data was published, there were about 4,600 commercial banks and about 7,000 thrifts in this country. And here are just some of the largest banks in the world. The top 3 are in China. Chase is the largest in the U.S. Chase has since grown quite a bit since this data came out. They just absorbed a bunch of banks that failed recently. So these numbers are from 2018. These bars have changed in a bit. But these are some of the largest banks in the world. As for the functions of the Federal Reserve can do the following things. It can issue money. All money is issued by the Fed. However, it doesn't print money. That's the U.S. Mint. The Treasury Department is who actually prints the dollar bills, but it's issued by the Fed. They set reserve requirements. This one's important, or how much money a bank has to keep of its deposits in reserve. And we're going to go through all of these things in the next 2 chapters. They lend money to banks. They collect checks, so they help provide the banking system with a means of collecting on checks that are written. They act as a fiscal agent for the federal government, so they collect money owed to the government from taxes and also assist with government spending of equally large amounts. They supervise banks and have the power to shut them down or take over their operations or make them do things. And the big one, they control the overall money supply. The Federal Reserve was once again established as an independent agency, and this protects the Fed from political pressures because the members of the Board of Governors serve very long terms, and no one president can appoint them all. They are not generally subject to the whims of politics like our elected officials are when we went through fiscal policy. And this enables the Fed to take actions to increase interest rates in order to stem inflation as needed. This is something we've been seeing regularly recently, where every meeting recently the Fed has continually raised rates. They've started slowing down how much they've been raising them because of the severe inflation our economy was dealing with the last couple years. During the Great Recession, the Fed had to step in quite a bit. So the recession, once again, and we touched upon this in previous chapters, was touched off by a default crisis in the mortgage industry. Many bad mortgages were written. People who should have never gotten a mortgage, who couldn't prove their income or anything else, were given home loans. And this was caused by many things, some of which were good, government programs encouraging home ownership. But the problem was a lot of people who purchased homes probably shouldn't have. Real estate values had been in a bubble and then started declining. And then the banks themselves took these mortgages and turned them into bonds, which they sold to other banks and other companies, and they started to all collapse. And this kicked off the very large recession we saw at the end of the 2000s. So as a consequence of this, the Fed had to get involved to keep the economy propped up, and we'll get into this in a moment. Why this happened, banks securitized really bad loans, so they bundled groups of loans into types of bonds, and as these loans started defaulting, the whole system collapsed. And many homeowners were what were called underwater, meaning they owed a lot more money on their homes than they were worth. So a lot of them just stopped paying their mortgage and walked away from the home, leaving banks now with foreclosed homes that weren't very valuable, and the banks suffered more and more and more, and it once again almost took the economy down with it. In 2008, Congress passed what was known as TARP, the Troubled Asset Relief Program, and it allowed the Federal Reserve to make $700 billion in emergency loans, saving several banks from failure. Now, the Fed in these situations is what is known as a lender of last resort. If no one else will lend to these banks, the Fed generally will. And that is how they can prop up the economy in bad economic times. So in light of this, Congress passed what was known as the Wall Street Reform and Consumer Protection Act, and the point of this was to try to prevent the practices which caused the crisis we saw, and also mitigate that moral hazard problem. So this act gave the Fed much broader authority to regulate banks with the hope of preventing a reoccurrence, but there's been a lot of criticism of this, arguing that these protections existed and weren't used properly, and you could argue they still aren't being used properly, and also government policies encouraging people to buy homes who probably shouldn't have contributed to the crisis as well. So the Fed has to act to both banks that are solvent and insolvent in times like these. So what do we mean by this? A bank that's solvent but illiquid means that they are not broke, their assets are worth more than their liabilities or debt. However, they may not have enough cash on hand to be a bank, to make sure they have enough cash to give to consumers who write checks or go to ATMs and things like that. But they're not going to go out of business if they can borrow money. Whereas a bank that's insolvent, their debt is far exceeding their assets, and they are, for all intents and purposes, insolvent or bankrupt. The Fed propped all of these firms up regardless. So knowing that, if this happens in the future, and we saw this happen again with COVID, and we've seen it happen very recently with some of the bank failures, such as Silicon Valley Bank and Signature Bank, and the ones that you may have seen on the news in the last few months, this is the moral hazard problem come to life. If you know that there's a good chance, if you run your business incredibly risky if you're a bank, and if it all goes to hell, the Fed is going to bail you out, well, you're probably going to take as many risks as possible, because if it works, you'll make a lot of money, and if it doesn't, it becomes someone else's problem. And there really is no good answer to this, and it is a problem that will continuously appear. Every time the Fed or the government bails something out, is it increasing moral hazard going forward? Because companies themselves may be much more willing to engage in risky behavior. And that's the point of contention I will leave you on in Chapter 14, and that'll take us to the end of Chapter 14.